Welcome to Opal TV. I'm with Justin Kendrick. He's the co-founder and portfolio manager of Binjai Hill Asset Management in Singapore. Justin, I'm curious, how did you end up in Singapore?
I got to Singapore in 1992, having been in Hong Kong for a couple of years before that. I started in Asian broking back in 1987 with Crosby Securities. And Crosby Securities was very much an Asian broker focused on small caps, smaller emerging markets. And that's pretty much what I've moved on to do in terms of the fund. So I was in Hong Kong, then moved down to Singapore, set up a corporate finance business for Crosby Securities. And then in 97 moved on to HSBC, where I was a regional head of sales, and then a bit later on to ABN AMRO. And after several years of working for large companies and watching the same mistakes being repeated, I wanted to set up and do something by myself, and thus the small cap fund that we're now doing.
Justin, tell me more about your company, Binjai Hill Asset Management.
Binjai Hill was set up in 2004 and is focused on Asian small caps. We've got 3 funds. One is a UCITS fund, which we established last year. We have a Cayman Island long-short fund, and we have a smaller long-only fund. The team is 6 people, very experienced team. The 2 principals have over 50 years of combined investment expertise, most of which is in Asia. We've got risk management, and we have a pretty strong investment process and a back office. Our 2 main funds are, first, our Cayman Island fund, which we established in 2004. It's a long-short mid-cap fund and is very much focused in terms of absolute return. We have a track record, and the annualized return over the 10 years, we've compounded at just over 13% gross, and we've been able to do that with lower vols of around about 12 to 13%. On a risk-adjusted return, we feel the fund has done well, with volatilities roughly half that of the MSCI, and we've returned in excess of the MSCI through that period. That's our longest established fund. More recently, we've translated the same strategy into a UCITS fund, the Asian Special Opportunities Fund. And as far as I know, this is the only UCITS offering of a long-short mid-cap fund in Asia. It's only been going for a few months. It's exactly the same strategy as we do on the Cayman fund, and we hope to be able to replicate the same track record and performance on that fund as we do on the Cayman fund.
With Binjai Hill, you're focusing on Asian mid-caps. Tell me more about this universe of the Asian mid-cap stocks.
Big universe we have. We've got roughly 15,000 companies to choose from, and this is actually a very key point about the mid-cap space, is that the opportunity set is very wide, and from that an active manager has got a lot of choice to pick from. And the alpha that one generally gets in the mid-cap space is roughly 2/3 of the return versus a large cap that's often the beta is 2/3, the alpha is 1/3. So from our perspective, an active manager, this is one of the reasons, or one of the key reasons we're there. What we do, however, is that 15,000 across many markets is too large an opportunity set. So we reduce that by looking at sectors that we understand and not sectors that we do not understand. So from our perspective, we tend to focus more on the domestic demand stories in Asia. Our view is structurally the way to play the Asian mid-small caps are to link that to the strong domestic demand that is driven by structural factors. We look across the whole region, but in terms of our real focus, since we've started, we've focused more on the ASEAN markets and the Indian subcontinent. And there's a reason for that, and that is that the structural demand story, the demographics, are much stronger in places like Malaysia or Indonesia or India than they are in the more mature markets like Korea or Taiwan or even China, where, for example, the labour force is reducing. More recently, we've actually taken a lot more interest in Vietnam, population of 100 million that's growing quite rapidly, where 50% of the population is under 50, as another good, strong, demographically driven domestic demand market. Asia's not homogenous. Each country is very different, the politics, the cultures, the economies. And so from our perspective, our fund is very much driven by looking at sectors which are country specific. And so we're looking at the property sector, the financials and so on. As a fund, we're a little bit different from the traditional long-only bottom-up stock-picking fund. We think that the top-down is important too. The political risks are a very key driver behind some of the Asian markets. And in a bad political situation, you have a bad currency, a bad economy, and even good companies will suffer in that environment. So from our perspective, from a portfolio risk point of view, we do look at top-down from a risk management perspective for the portfolio.
Please tell us more about your portfolio construction process and your risk management.
Portfolio construction is, apart from what we mentioned earlier on in terms of the top-down country decisions, it's very bottom-up. We have a very detailed, auditable investment process whereby we meet companies, we speak to the companies, we write those up, we do our own internal research. And so very much portfolio construction is looking at the countries we want to be in and then companies that we like. And from that perspective, we've delivered a very disciplined, very detailed research process because we've met 2,500, 3,000 companies over the 10 years we've been in business. You have to have a disciplined process to remember that, to contain the information, to use that as a data bank to go back to. And it's something that we're very proud of in terms of the amount of attention and time we put towards that. The fund style is to provide a risk-adjusted return. We are not simply a long-only fund looking to make spectacular returns in a good year and lose it all the next year. We look very much at risk-reward. To do that, we've got a very detailed risk management process whereby we risk manage every position. We do not tolerate significant drawdowns, and either at an individual position or at a country level, and particularly at a currency level where we are quite often hedging what has happened. We have a specific dedicated person, the portfolio risk manager, that works with me as a portfolio manager, and they have substantial discretion in terms of what to do with position sizing and when to put on trades and take positions out. We see quite a number of opportunities, and maybe what I should do is perhaps divide it into where we see good opportunities in the shorter term and where we see opportunities in the medium to longer term. Shorter term, obviously there's this tapering off risk for emerging markets, and to that extent the ASEAN and South Asian markets are perhaps more vulnerable to some damage, and we are relatively cautious in the short term. Having said that, once tapering off starts, we believe there could well be an opportunity to buy back into some of those markets. Malaysia, we're quite positive about. India, where the political change under Modi, if he gets elected, could be very positive, would be two places that we certainly would be looking at. In the shorter term, however, we're more focused on North Asia. We believe the plenum in China is a watershed event, not just for China, but for emerging markets as an asset class more generally. We do not think people fully understand how important, how impressive the reforms potentially will be and what that will do to re-rate the market. We also like Korea. Korea will be a recovery market as exports pick up, but people often miss the fact that we're now seeing a domestic recovery. The housing market, which has been going through a bust, bottomed out in September. The government is stimulating the economy and helping households, particularly the lower income households. So we see Korea as being potentially a market that could break out of a 3-year trading pattern and actually provide pretty good returns over the first half of next year. The won is a pretty stable currency relative to some of the emerging market currencies into a tapering off environment, so that's another positive.
Tell me more about your investor base. Who is invested or who is interested in your fund?
Our current investor base in the Cayman Fund, mostly my family, some high net worth individuals and some family officers that have been with us for a long time. More recently, we've established a UCITS fund, which is seeded by Erste Bank from Austria. And we're optimistic that that new structure can appeal to a new set of investors that otherwise wouldn't have been able to invest into our funds. One of the problems that a fund in Asia can have is the cyclicality of money and the strategy, whether it works or not. We believe that the small mid-cap strategy is going to be of some appeal over the next few months or years as investor interest returns to emerging markets and people look beyond the larger caps. People are interested in our fund because we're not a classic long-only fund relative return that aims to shoot the lights out. We're trying to do a fund that will give you a solid, sensible approach to investing in Asia whereby we reduce the downside risks. We're very much aiming at preserving people's capital and enabling people to sleep at night. And thus we look at a risk-adjusted return rather than trying to shoot the lights out and then suffer, if we get it wrong, a big drawdown. We're a relatively conservative fund, and thus why we are aiming to be long-short in a space many people feel should be long-only. As an example, during the global financial crisis, the Asian mid-cap space fell roughly 70% in 2008. We fell just over 20%. Obviously, we would like to have done better, but historically, the fund has roughly done around 1/3 of the fall and has achieved around about 2/3 of the up. And that's why we've been able to compound at around about 14%, is that we've generally reduced the downside very substantially through the 10 years we've been managing the money. We've been going now for 10 years, so we now have a track record that I think people can look at and judge us by. We've delivered over 13% compound returns for a volatility that is roughly half that of the MSCI. So on a risk-adjusted basis, we actually believe we're providing a pretty solid return to investors, and one that people can trust and feel that even in this space, which can be volatile and can be illiquid, that we as a fund are able to cope with that and yet still deliver solid returns. The other point to note is that the principles of the fund have been there for 10 years. We are the same people. And we've had no style drift. The strategy that we adopt today is the same strategy that we were doing when we started the fund. We are the same people, the same strategy, and the same disciplined approach. For us, risk management isn't simply risk managing every position. It's also looking hard at whether one should be invested and not. If we feel in an Asian context or in an individual market context that the rewards are not there relative to the risk, we are quite prepared to take the portfolio down and move quite heavily into cash. So, for example, during the global crisis, at certain points we were pretty close to 100% in cash or being fully hedged.